Hello, my friends. This is Brad Brain. I hope you're doing well. Today, I want to talk to you about, in my mind, what is the superior way for making investment decisions. And I'll tell you where this video came from. I just got off the phone. I get these calls all the time. People call me up. I don't know who they are, but they want me to buy their stuff, right? In this particular case, the guy's got a private placement. There's a lot of jargon that sounds pretty sexy. Private placement, that sounds pretty sexy. When I hear that stuff, I think opaque. I think black box. I think things that actually are not benefits. They're potential problems, right? But here's the deal: is that there's so much stuff out there that sounds really good. Wasn't that long ago that cryptocurrency sounded pretty good, didn't it? Right? Do you remember back in the day? Hey, it was decentralized. It was what else did they say? Blockchain technology, right? All this stuff. It sounded great. It sounded fancy. It sounded complicated. Well, I think a lot of people have a different opinion now that things have transpired. Here's the funny part. Right now, this is in the news a lot. Well, the news I look at, right? My news feeds. Due diligence. All these people that should have known better, but they didn't bother to check things out. And, well, now they're regretting it, aren't they? And so um, here's where I'm going with all this stuff. There's always a great story, but a great story doesn't mean it's a great investment. So here's what I look for when I look for a great investment. And this is I'm borrowing this from Warren Buffett, which if you're going to borrow some ideas, you might as well borrow it from the greatest investor the world's ever seen, right? So Buffett wrote about this long ago in one of his shareholder letters, annual shareholder letters. I don't even remember which one. This idea has been around for a bit. It's called the double dip. Now, this is the important part for people to understand. If you understand this, then things will make sense. But if you don't understand this, it's all going to seem just as mysterious as blockchain technology and all these other fancy things. Here's the thing. There is a distinction between the value of a business as a business enterprise and the stock price. Okay. So the business is what the company is doing, how much money they're making, what their operations are. What do they do even? Right? What do they do? Do they make shoes? Do they make computer software? What do these guys do? And then how much do they sell it for? Do they make a profit? That's the business. Now, the stock price is what shares of the business are trading for. And you would think that the two things are connected, but not always. So here's what I mean. Let's say, now forgive me if this turns out messy because, my handwriting is not good. Best of times, I'm going to try to do this with a keyboard and a mouse here. We are going to look for, just need to pull up some stuff here. Something like this. Okay, so we're going to say that we have a nice little business and it grows over time. Okay, now I'd like to show this maybe with a few variations in that, but I don't have those type of computer skills, so we're just going to say it grows in a straight line. A little bit of an artificial assumption, but bear with me on this. Okay, so this is the value of the business, right? The operating business, whether that's a grocery store or whatever they do. If they sell groceries, whatever. So we can assume that a well-run business, good management in a good industry, it will grow over time, right? As they develop new markets, gain new customers, pay down debt, et cetera, et cetera, et cetera. So this is the straight line. Now, here's the important part. We can get people who get really, really excited about an investment and they will bid the share price up. And there's no shortage of examples of that. I mean, going back not too long ago, when marijuana stocks became publicly traded, there was a great rush to buy these things. And in that excitement, what happened is people bid the share price up with the benefit of hindsight, far beyond what the companies were actually worth. Right? When you look at what these companies were actually doing and what they were producing and how much they were selling it for, the share price went like this. And that's kind of a bad deal. Like I don't think it makes a lot of sense to pay this type of price when the business is worth this. And yet this happens all the time. Why that is because people think they're getting in on something and the business is going to grow into something huge. Maybe buying Netflix in the anticipation of streaming services taking over the world, and that would be why, right? It's all about anticipation. It's not about necessarily the reality of the business as it operates this second, but they're thinking what it could grow into. Now, here's the problem: is that when you're doing this, you're paying for potential, right? You're paying this price here for something that's worth this, and sometimes that works out, but often that's hard for me to justify, to overpay for something. So what value investing is all about, I'll see if I can match these little lines up here. Well, what I want to do is, because it doesn't always stay this way. Sometimes the share price will come down, and maybe I'll just finish this off with some graphs that go like that, right? So what happens at this point, this is where people are really pessimistic about a business for some reason. They're willing to let it go at a discount. Right now, I think perhaps we're seeing this in the real estate market, and partly it's because of the fundamentals with higher interest rates, meaning borrowing costs are higher, and the prospects of recession. But certainly, we've seen real estate prices come down a little. But potentially, I don't know if this is true or not with real estate as it exists today, but potentially, you could be able to buy something at a bargain, and that's what value investing is all about. You might not see bargains that would be kind of consistent with the way I freehand drew these lines in the real estate market, but you can see this in the stock market all the time as people get really concerned about their shares of their investments. What they'll do is they'll see the share price come down, and then eventually they'll become quite concerned that this pattern continues till the thing is worthless. So they'll want to sell their shares and get out at any cost, right? Well, for buyers of wonderful businesses, this is what we wait for. This is Christmas for us. This is the time to go shopping, because when you can buy a business that's worth this part here, if you can see my mouse tracker, but for this price, I think, who was it? It might have been Peter Lynch who said this. If it wasn't, it was another famous investor. He's looking to buy $1 for 50 cents. Now think about that. If you can buy $1 for 50 cents, that's a pretty good deal, right? So if you can buy shares of a business that are worth this at that price, that sets you up for a couple of really interesting future outcomes, potential future outcomes. Well, first off, there's certainly a lot less downside, right? If you pay this price, hopefully you can. You know what I'm going to do? Let me just get another color pen here. If you can pay this price for something that's worth that, then obviously there's a lot less downside that can happen, right? If you pay this price for something that's worth that, if you overpay, then you're setting yourself up for a future price decline. But like, let's say you buy it here. You might not get the timing perfect. People rarely do, but there's going to be a lot less downside if you buy with this, we call it a margin of safety, right? This is the margin of safety, the difference between what the company's actually worth and what it's temporarily trading for. But this is far more than just a defensive strategy, although clearly it is. It's also potentially very lucrative too, and it comes from two ways. This is where the double dip analogy comes from. The first is the natural growth of the business over time. But the second part is when the rest of the world realizes that these shares are trading at such a deep discount to their intrinsic value and bid the share price up. That's the double dip, the combination of the realization that these things are underpriced and the natural growth of the company over time. So let me just maybe finish off my little key here. I should have put this in a while back, but the curved line is the stock price. Curvy line. And this is the important part, is we can get a disconnection between what the business is worth, the straight line, and what it's temporarily trading for, the curvy line. You don't necessarily want to overpay for something. I like to buy $1 for 50 cents when that opportunity presents, not just so I don't end up paying $2 for something that's worth $1 and living through that painful downturn, but also for the future growth that we can hopefully see going forward. I hope this stuff makes some sense. If it doesn't, though, let me know, because I'm here to help. I'm Brad Brain. Stay healthy.